Once upon a time, before algorithms dominated markets, before liquidity moved at the speed of light, investors believed something simple. If you study hard enough, if you analyze deeply enough, if you're intelligent enough, you can predict outcomes. That belief built careers. It also ended them, because in markets, ignorance is dangerous, but certainty is lethal. And the most expensive portfolio collapses rarely begin with confusion. They begin with confidence. Section 1. The illusion of superiority. Most investors believe they are above average. Statistically, this is impossible. Yet surveys repeatedly show that over 70% of active traders believe they outperform the market. This is not arrogance, it is architecture. The human brain is built to preserve identity, and identity prefers superiority. When you place a trade, your mind doesn't evaluate probability first. It protects competence. You don't think, I might be wrong. You think, I've analyzed this. That shift is subtle, but it is the beginning of structural risk. Pause for a second. On your last trade, were you managing risk or defending a conclusion? Section 2. Overconfidence is not loud. Overconfidence is rarely visible. It doesn't sound like I can't lose. It sounds like this is obvious. There are 3 operational layers. 1. Overestimation. You overrate your skill relative to others. 2. Overprecision. You underestimate uncertainty in your forecasts. 3. Illusion of control. You believe research eliminates randomness. Markets are probabilistic systems, but overconfidence converts probability into narrative. Narrative feels stable. Probability feels uncomfortable. Most investors choose emotional comfort. Section 3. Early success. The dangerous validation. Overconfidence rarely begins with loss. It begins with early wins. Consider this structural pattern. Trade 1, profitable. Trade 2, profitable. Trade 3, profitable. The brain concludes, pattern detected. But markets reward positioning, not insight. Short-term gains are often liquidity-driven, not intelligence-driven. However, once you attribute gains to skill, 2 changes occur. Position sizes increase. Risk tolerance expands, not consciously. Chemically, dopamine reinforces conviction. Conviction scales exposure. Exposure magnifies fragility. That is how small competence morphs into catastrophic vulnerability. Section 4. Intelligence amplifies the bias. Here is the paradox. The more analytical you are, the more dangerous your confidence becomes. Because intelligent investors construct persuasive internal arguments. You can justify holding longer. You can justify averaging down. You can justify ignoring volatility. You can defend almost any thesis. And when intellect combines with ego, exit discipline weakens. The market does not reward explanation. It rewards survival. Institutions understand this. Retail investors personalize it. Section 5. Trading frequency and ego. Overconfident investors trade more frequently, and frequency erodes performance through transaction costs, tax inefficiency, slippage, emotional fatigue, cognitive depletion. But the deeper issue isn't cost. It's ego. Every trade becomes a declaration, and declarations resist revision. When price moves against you, overconfidence whispers, it will reverse. And sometimes it does, which reinforces the bias further. Random success strengthens flawed process. That is how cycles persist. Section 6. The status defense mechanism. Loss in investing is rarely about money alone. It is about identity. If you view yourself as intelligent, being wrong threatens hierarchy. So instead of exiting, you defend. You hold, you rationalize macro shifts. You reinterpret data, you delay acceptance. And time converts manageable drawdowns into structural damage. Professionals detach identity from position. Amateurs fuse them. That fusion is expensive. Section 7. How institutions design against overconfidence. Institutional investors assume error. They build systems accordingly. Defined position sizing, maximum portfolio risk thresholds, pre-committed exit rules, committee review structures, scenario analysis, probabilistic modeling. Notice something. None of these tools eliminate confidence. They restrict it. That is structural intelligence. Retail investors seek certainty. Institutions engineer restraint. Section 8. The strategic reframe. Confidence is not the enemy. Unbounded confidence is that capital intelligence is not about predicting outcomes. It is about managing exposure. Shift from, I believe this will happen, to, if I'm wrong, this is what it cost. That is maturity. The edge in markets is not foresight. It is position control. Once upon a time, investors believed intelligence was enough. But markets do not reward intelligence alone. They reward discipline under uncertainty. And the most dangerous investor in any room is the one who believes they've mastered the system. Because in adaptive environments, the system is always learning. The question is not whether you are confident. The question is your confidence constrained by structure or amplified by ego? That difference determines survival.